As the rotation away from software and tech continues, other segments of the market are starting to gain momentum, with energy and materials seeing an inflow of new investments. For more on this, we're joined by Theresa Shutt, Chief Investment Officer at Harbourfront Wealth Management. Theresa, thanks as always for joining us.
Thanks as always for having me. Hi, Roger.
Hi. Quite a day. It's a bounce back for the NASDAQ.
Indeed.
It's up by 1.33. Are people having second thoughts, or are we still seeing that rotation?
I think we're still seeing that rotation. I mean, certainly U.S. stocks have been rocked this month by these concerns over AI CapEx and whatnot. Obviously, we've got the FOMC minute release later today that will give some insight into maybe the outlook going forward, under Warsh's leadership. I think people are looking to that for some sort of signaling. But I do think, there is kind of a decisive shift in leadership underway in terms of the market. So, investors are obviously moving away from some tech names, in particular software, and traditional S&P segments, industrials, financials, energy, and materials are gaining, fairly strong momentum still. And I think it's really, kind of the fact that these traditional companies still provide this sort of haven of earnings reliability. They're largely insulated from some of the AI-driven margin compression. And in fact, I think that, they're really well positioned to benefit from these shifting dynamics. And so what we're seeing, I think, is investor preferences being recalibrated. According to the Investment Manager Index, industrials, energy, basic materials have climbed to the top of the sector rankings, with industrials climbing to the #1 spot, and the first time in 6 years. And I like to talk about Caterpillar. Like it's a prime example of an industrial name that's returning to favor, and not just because of its traditional model. It's in fact, I think, a standout because it's really a prime beneficiary of AI-driven infrastructure growth. So while we talk about CapEx spend and whatnot, is it too much? Is it too little? This company in particular, their construction equipment is essential for building new data centers, while the power and energy division is thriving by supplying turbines and these large reciprocating engines that meet the redundancy needs of these facilities. So their shares over the past past month, in fact, have risen almost 20%. And so I think there's really some interesting dynamics going on in the market. And I think, markets need to focus less on, pricing AI potential and pricing AI economics. And some of these companies that are benefiting from AI, as well as providing that, kind of stability in earnings, and the fact that the U.S. administration is investing in the industrial sector, in the defense sector, I think this rotation is going to continue.
All right. And with the AI economics, are you talking about companies that like Caterpillar, or companies that are starting to incorporate it?
Yeah, both. I think, now we're finally starting to talk about the winners and the losers, I think. There was a point where really the AI narrative was this all-encompassing force, and that drove all markets higher. Now we're seeing the selectivity emerge, and we're seeing that some earnings reactions like Cisco, Shopify, maybe investors are less impressed. I mean, good growth isn't enough, frankly. So we're starting to see the market kind of sort the AI trade, and I think you're seeing winners, which is the compute, semiconductors, AI infrastructure, I think what we're calling picks and shovels, that is hardware over software. And I think for these players, AI demand is visible, it's contractual, it's front-loaded, and the revenues are tied to the capacity build out, not end user monetization. And I think that's really important. And we're also seeing the enablers do well. So this is power, natural gas, players such as this, which I think is also really interesting. Now on the loser side, obviously, we're seeing, software obviously come under pressure. And that's really because, the AI disruption and some of these applications will undermine their moats. And so people are starting to question kind of these long-terminal multiples, not so much near-term growth. I mean, obviously, some of the software is essential for critical mission uses at large organizations. They're not going away anytime soon. But I do think that there is kind of a shift away from this idea of like everything that's AI is great to, maybe we need to really think about who's going to benefit and who's not, and, who's adopting it quicker. in the most intelligent way. I think there's going to be a risk of kind of AI washing, much as we saw with the ESG theme, which was the greenwashing that we saw. So, we have to be really clear about, which companies are actually using it, and how it's affecting their productivity, innovation, and their margins.
All right, and just going back, a couple of things I just wanted to bring in there about the earnings. They had grown. Is it being unrealistic? Is the market being unrealistic with the reaction to some of the earnings that we're seeing? Are they going to have to eventually say, you know what, these are really good earnings and the companies are good?
Yeah, I think so. I think, what's interesting is we're seeing, more micro and earnings really, really dominating the headlines. And there seems to be this kind of shrugging off of some of the macro data that we're seeing, whether that's jobs, inflation. People just are really focused on how well and profitable these companies are doing without kind of thinking about the longer term. And I think that's starting to shift. Really right now, I think stock selection is really critical. I think this is a great time for stock selection. I think you saw, Berkshire Hathaway had made some interesting choices. They've continued to trim Apple. They sold Amazon. They're buying the New York Times. So I think we're seeing, this kind of at work where, people are starting to look beyond just these earnings and the fact that, they continue to beat expectations, and more announcements from NVIDIA about partnerships with Mega and elsewhere. I think people are starting to really step back, be more pragmatic, and really understand, where those earnings are coming from and how sustainable they are.
All right, we'll have to leave it there, but Theresa, thank you as always for joining us.
Thanks, Roger. Thanks for having me.
Theresa Shutt is Chief Investment Officer at Harbourfront Wealth Management.